Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Back with another stock review today, and yes, I will be branching out and doing different types of videos. It's just that we've got so many of these to get through that I've got to prioritize. Okay, so I've started by doing what's in the fund. Okay, Crassus Investments on eToro. I'm a popular investor on eToro, so if you want to check it out, I'll leave a link in the description. And so we're going to get through the reviews of all the stocks in the holdings first, and then we'll try and branch out into other things. I've done some sector reviews, so you can obviously go and check them out, and I will have to do one for the iron ore sector as well, or industry I should say. Okay, we're looking at Rio Tinto today, a very famous company, and if you're another fellow Aussie, you'll know all about Rio Tinto. Iron ore is a very important part of our economy. If you haven't already liked and subscribed to the channel, I'd love it if you could just hit the like and subscribe button, and you'll stay up to date with what I'm doing and different companies that I'm looking at. And for our Crassus fund, we have an investment formula, Crassus investment formula. And what is that? We're looking for companies with low debt or manageable debt, margin of safety, sales growth, strong margins, free cash flow, and our share buybacks ideally. Without further ado, let's get straight into it. The quick facts on Rio. Okay, we're talking the London Stock Exchange listed company, so everything will be quoted in pounds. Revenue at the end of this year, their fiscal year, is expected to come in at 63.5 billion. Top line growth, 7% CAGR over the last decade. EBITDA 13.6, 13.6%. So their margins have been widening. Market cap almost 84 billion. 85 billion in terms of enterprise value, so not much debt carried by the company at all. Their price, as at the time of recording, £51 and 11p, and 1.6 billion shares outstanding. They've been flat on buybacks over the last year, but they haven't diluted, so that's always the issue with the miners. We want to be aware of the dilution factor. We don't want to see shares issued if we can help it, unless there's a very good reason. The dividend yield, LTM, is 14%, okay, which is phenomenal, especially for a company with a track record of return on capital of 36%. Yes, that depends on the sort of the 5-year time span within which you'll be measuring. It's cyclical commodities business, so it's not always going to be sunshine and rainbows. But their debt to EBITDA is basically flat. Okay, so they're in a really good position with a strong balance sheet. They've got a lot of retained earnings from which they'll be able to sustain that dividend payout. And so I think we could value this mainly as a dividend play and have any equity appreciation as an equity kicker on the upside. Key points. So it's a more diversified miner. Its brethren, so to speak, would be Vale, Ferrexpo, which I recently took a stake in, and BHP. So Rio is probably the most diversified. They do have some gold and copper and even uranium interests, I believe. But iron ore is the main gig. Long-term CAGR, including dividends, this is return to investors, including the dividend of 10%. Okay, so very, very good. Very, very good, guys. It supplies us with nearly everything. So, the house I'm in, it couldn't be possible without steel and all the commodities produced by the likes of Rio. They've improved the discipline when it comes to applying funds to Capex, so the earnings to Capex, and that will keep the commodity prices more stable moving forwards. Very, very key. And I've got a great chart that I've taken from the quarterly report that will show that, beautifully illustrated. Free cash flow return to shareholders via dividends has been good and will continue to be good in the future, I would estimate. Here's a quick look over the year's price action. So prices have risen 23% over the year, and as you can see, they were flying high on that above $200 DMT for iron ore. Since dropped by about half, but we're still ahead of the game if you own Rio, 23%. This next one is a longer term, so what is that? Wow, 23-ish years in terms of price history for Rio, and it's up and to the right, okay, which is a phenomenal effort from a cyclical commodities capital-intensive business. It shows that management know what they're doing. They've been able to survive the good times and the bad times and distribute wealth to shareholders, which is exactly what you want to see. It's a very, very interesting chart. And this is the chart I was referring to. Okay, so on the left-hand side, this is the earnings of the company. Okay, and the line here is assuming 62% purity of iron ore per DMT. And as you can see, you have your bull markets where they're earning lots of money because iron ore prices are high, basically. And then you've got your bear markets. Let's have a look. So bull markets are the authors of bear markets are the authors of bull markets. High prices are generally the cure for high prices, and low prices are the cure for low prices, and all the other economic cliches. If we look at total Capex, okay, in the billions, that's what the company is putting into, in this case, new production. So you're earning money and you think, wow, this is great. Iron ore's really high. We're going to go out and we're going to take over new mine sites, buy new companies, invest in equipment, so we can just put more and more of what we sell on the market. And as you can see here, illustrated perfectly, eventually you have an oversupply. And if you have an oversupply, what do you think happens to the prices of the commodities which you've been flooding the market? They start to drop. And so therefore your earnings also drop. So let's have a look. First half of 2011, in particular, let's look at 2012 and 2013 down here. They are pumping out more money than they're actually earning into Capex. Okay, so then you have this massive increase in supply. They were trying to keep up with the growth of China, and so once the iron ore prices start to drop, let's go back to the left-hand side and look at their earnings. Okay, so the earnings take a real whack, as you can see through the sort of 2015, 16, maybe even 17, although things started to pick up again. What's interesting here, if we look at the 2020 onwards, 2019 onwards, you can see they've been much more responsible. They're earning 4.9 billion, 4.8 billion, 12.2 billion. That was a really good year. So how much are they investing back into new production? And it's around about a ratio of 50% for 2019, 2020, and then 2021, it's about 4%, about a quarter, so 25%. So if you're earning 12.2 billion and that Capex, if that was back in 2012, they're investing 7.6 and 7 billion in Capex on 5.2 and 4.2 billion. They're basically investing double what they earn. So we would expect, if it was the old days, they'd be putting 9 billion and 24 billion back into new production, but they're not doing that. They're being very smart. They're not reaching into the debt market. They're just simply taking a percentage of what they earn from free cash flow and putting that back into Capex. And that will lead to less peaks in supply coming onto the market. And so I think you'll see iron ore prices more stable for longer, at least in terms from the supply side of the equation. What happens with China with this Evergrande situation, and will they continue to pump out empty buildings and roads? We don't know, and so that will obviously affect the demand side of the equation, but at least the companies are being responsible from their side, and like what we're seeing in the oil and gas space, they're not, at the moment at least, are not making the mistakes of the past in terms of overproducing and flooding the market with supply. All right, here we go. Projections out into next year. So analysts have given us estimates for free cash flow, EBITDA, and earnings per share. And we're not looking for high multiples, okay, just because it doesn't seem to be a popular industry. So we're going to assume that we don't get multiple reversion. We're just going to go with 6 times the free cash flow, 6 times EV to EBITDA, and a measly 8 times earnings. These are the implied inputs, okay? And as you can see here, we're expecting, if all else comes to fruition, at the end of 2022, the price will be around £87 and 38p, okay, which is about 170% upside from where we've entered and taken our initial stake. If you account for the time value of money, that's about a 70% IRR. And if you're looking at 2 years, so let's say things don't happen quite so quickly, but we have another year of trading to get to that same price, we'd be looking at still a 31% IRR, which is obviously phenomenal. You double your money in 2 and a bit years in that case. Okay, we take the EBITDA per share and we extrapolate that out. Using historic median growth, if we are paying, and I know it's a dollar sign there, but it's really pounds, so just make sure you've got that in mind, because you might get confused between the listings. If we're paying £51 today, what is that if we discount it at the weighted average cost of capital? What is that as an IRR? So nearly 33%. Really good investment rate. So as long as we're confident that that's going to be near enough to taking place, it's obviously a no-brainer from an investment perspective, in my view anyway. And it's just my view. Same deal using the cash flows, same initial stake price, discounted cost of capital. If we take the cash flows, we've got a 22.57% expected IRR over the next decade. So a bit of the old mental math is an average is about 25-26% IRR if you average the EBITDA method and the free cash flow method. Okay, now apologies for this. This is a horrible looking chart, I understand, but what I wanted to do is value the dividend. And if we said, okay, forget anything else, forget the equity part of the equation, we want to know, we're most certain about the dividend and the income. So we want to discount that income, and we want to know, if we just rely on the dividends alone, what should we be willing to pay for the company to get our target return of 20%. And anything that happens with the share price upwards from there is a bonus. Okay, so here what I've done, we've taken the expected dividend for last year. It's supposed to be higher than that this year, but anyway, we'll just use that and use a growth rate, so 10% and 15%, maybe a little high, maybe a little low, up to you. I think that that's in line with the last 10 years as a growth rate, so I'd expect that to be quite reasonable. And our target rate of return is 20%. So we're discounting these future dividend returns by 20% into perpetuity. I've cut it off at 20, just so 20 years. It actually goes to 30 years. I've cut it off at 20 years just so it'll fit on the slide here. What that's telling us is, if these projections are accurate and they come to fruition, we would expect to pay no more than £74.36 to be able to have a 20% return off the dividend alone. Okay, so if we're saying that exit multiple will have a dividend yield of 6%, we'd have an exit price that would give us that yield over 20 years, which would account to an IRR of 20%. So this is really telling us a story here of saying that we think that there's a hell of a lot of upside potential with this investment. Same thing there. All right, here we go. We've got our big picture. So we've got our base case, bull case, bear case. I've overweighted the bear case way more than what it should be at 30%, just for the sake of being conservative. Using historic growth rates is lower than historic multiples, and I've done the same thing for EBITDA, the free cash flow, and the earnings per share. Our average intrinsic value, if we discount it at 20%, £139, okay, and 2/3 of that would be £91. So, you know, provided that we're happy with where this company is headed into the future, then this is a severely undervalued company if you look at it from this perspective. However, you never know when it comes to the cyclicals. I mean, if the price of iron ore drops off a cliff, then they're not going to be making much money at all. And so it's just something to bear in mind. These companies can always look wonderful on paper, but you need to account for the risk. So the verdict is it's a buy. I mean, it's, you know, incredibly cheap from all the metrics that we've used. It appears to be cheap. It's got low debt, it's got margin of safety, sales growth, margins, free cash flow, and share buybacks / dividends. I mean, all things are looking good. But the current price of iron ore is about $105, and so who knows, the outside chance that things really fall apart in China and demand for iron ore and for steel dries up, and iron ore price could halve again, and then obviously that would severely impact the valuation of the company. But you've got to bear that in mind. And so if you're holding for the long term, I think it's fine. We've got a position in the company, 1.5% of funds. That would probably be the maximum. The only reason is that there are some other companies that are more risky but have a higher upside potential, which I'll be speaking about in a future video. 1.5% for a company that is mainly iron ore but more diversified is, to my way of thinking, an appropriate allocation for the resource sector. Thanks for watching. Disclaimer, if you just putting it back on the screen there, please make sure you take everything with a grain of salt. Make sure that you are doing your own due diligence. You're responsible for your own investment decisions, okay? So make sure that you accept the consequences of your actions, and that will make you put a hell of a lot more effort into researching your investments rather than just listening to people on the internet in and of itself. If you haven't already liked and subscribed, I would greatly appreciate you doing so. And if you've got some funds and you'd like to invest in Crassus Investments, just click on the link. It'll take you to the portfolio, and you'll see what we're invested in, and the performance of the fund is publicly available information. Thanks very much for watching, guys. I'll be back with another video soon, and I hope to see you then. Take care.